Welcome back to another episode of In Focus with Haversine Funding. Today I'm joined with a first-time co-host of mine, Vince Mancuso, Managing Director at Haversine Funding. Vince, thank you so much for joining me today. And I have two very special guests. I have Elliot Smith and Jorge Puig with Flatbay Capital. Thank you guys for joining us today. We wanted to have them on and talk about the changing market with commercial real estate. They're the experts. They have 20 plus years of experience in commercial lending with a focus on real estate. So wanted to have them join us to talk through all the insights, trends, and strategies that we're seeing. Thank you guys so much for joining us.
Thank you.
Thank you.
Yeah. So, tell us your story, Flatbay Capital, who are you guys, what you do, what's your niche?
So we started really out of necessity. And, my background is a combination of banking, commercial mortgage-backed securities, as well as asset-based lending. And we identified this niche, going on 6 years now, where we kept on seeing deals that were referred by banks. And there was a real estate piece attached. And there was not a good solution to effect a full bank takeout.
Right.
And so we designed our product around the need. And our product is $1 to $10 million commercial real estate loans with a focus on owner-occupied real estate. We do a lot of industrial, a lot of manufacturing, distribution, those type of assets. And really, there's a big benefit to work with other lenders. An asset-based lender, a factor, will oftentimes bring us into a transaction because they need the real estate piece in order to fully take out a bank.
Yeah. And, I think, what you kind of mentioned there is you guys started out of necessity of a need. You're able to get a pulse of the market, what it needed. As you mentioned, the other lenders, a lot of times they'll ask you to come in. In my previous experiences, that need was always there. There weren't lenders that were, well known that we could just reach out to that could come in for that real estate piece. Being in that space for as long as you guys have, you've been able to evaluate the changes in the market. So what are some of the trends that you're currently seeing? I know it's a big conversation that we're hearing. You guys are the experts. So what are you guys seeing there?
We could spend a whole podcast episode talking about this question. But the reality is that there's a real mixed bag of opportunities out there. And, our job is to try to focus on picking the right clients. So client selection is very important to us because, as a real estate lender, we're not solely just focusing on the real estate collateral itself. We're also looking at the operating company. And, one thing that we've learned is that if you don't pick the right clients, then when a real estate deal goes bad, it takes a long time to work out of them. And so there's a lot of due diligence up front that needs to be done, not just on the real estate, but on the operating company.
Right.
Identifying if they've figured out if they figured out what the problems are in their business, have they solved those problems? And so from a trend standpoint, we're seeing both. And there's fewer good deals than there are bad deals. And so the trend is really being proactive on your due diligence and trying to find the right deal and not catch a falling knife.
Yeah, that's right.
Have those trends evolved over time? What drives those trends specifically?
Good question. So I would say that, oddly enough, we're actually seeing, I would say that our client, George can, validate this, likely is that our client base now is probably better and healthier than we've ever had before. But I don't think that that's necessarily driven by anything other than there's more opportunities that we're seeing. So in the past, we may have seen 5 opportunities and now we're seeing 20.
Wow.
So we get to pick the best ones out of those. And so the trend is more deal flow, which is a direct result of the interest rate environment and, loans maturing at banks and then having to go somewhere. So the tide is coming up. There's a lot more deals, but it doesn't mean that we're going to triple our deal volume because we still have to pick the right ones.
Right.
So that's the trend.
Right. So what do you think's driving the additional deal flow coming where you guys have the option to be a little bit pickier and selective on which ones you want to pursue?
It's directly driven by the interest rate environment. And we can roll back to stimulus, that, all that money that went into the monetary system and what that did to supply chains and COVID and really we're reaping, all of that, that stimulus money now and the reality is that when loans were at 3.5%, 4%, and they're now maturing and they have to be reset at 8%,
Right.
the historical revenue of these companies can't cash flow those. So it's just simply a function of math. The math's not working.
Right. So with this increased deal flow, you mentioned you went from seeing 5 to 20 deals. Flatbay has to evolve, right? So how have you guys had to adjust your underwriting or your credit criteria to kind of fit the changes in the market and all the additional deal flow that you are seeing?
We do more due diligence now than we used to do. I would say that like anything in life, you learn from your mistakes.
Right. Yeah.
And so we have learned. I'll give you an example of something. We had a few clients that have been perpetually late over making late payments, and we never had anything in our loan documents that stated that there would be a penalty other than the typical 5% late fee. So we inserted something now into our loan docs that basically increases their interest rate after a period of so many different late fees or late payments rather. And so, it's a combination of amending your loan documents to reflect what you've learned over the years of making mistakes. But it's also, sometimes you have familiarity. Like you have a deal that you saw in the past that there's a similar deal that comes in and we say, we learned a lesson from this previous deal.
Yeah.
You know the questions to ask. And so you go into that deal and you ask the questions that you learned in the previous one. So we've layered in more due diligence, better software, better third-party systems to pull, kind of due diligence from different places. So really it's a combination of additional due diligence, but then also taking all the lessons we've learned over the years and implementing them now.
Yeah, and what I'd add, from an underwriting standpoint, because that's, my background was heavily in credit, is that we are constantly peeling back layers and layers and layers. And if you compare the level of due diligence that we do to a bank's due diligence, I would say we probably peel back more layers. Because a bank has a regulatory framework that they have to abide by, and so generally their deals are going to be cash flow positive and collateral if it's in the box, et cetera, and so they're going to be dealing with, in many cases, more perfect information, cleaner information, and books that are just, who doesn't want to lend money to a company that has a $10 million EBITDA, and so yes, boom, 2 to 1, 3 to 1 leverage ratio, right down the middle. For us, we're dealing with companies that have been through some choppy waters. That's where the name Flatbay comes from, right? Because you may be going through some turbulence with your banks or with your situation, at your company, and maybe you're losing a little bit of money and you have $1 million in losses, and it seems like the world is just falling apart, and maybe the ship is taking on some water. Well, you take a right turn to Flatbay Capital. You get the smooth bay there, the flat bay.
That.
And so that's where we're helping companies really, not just lending them money, but we're really sitting down with business owners and we're really giving them advice based on our almost 50 years of combined, commercial real estate and commercial lending experience, and we're helping them. And in some cases, I will say, when we peel back the layers, there have been instances where we could have loaned this company $3 million, $4 million, and the LTV was fine. They had a ton of equity in the property. Our advice has been, you know what, you need to just sell the property. Debt is not the solution, and we do that by turning stones, by peeling back layers, and in some cases, it's pencils down for us. Yes, maybe it's a 30% loan to value deal, and would we have lost money on it? Probably not, almost guaranteed not. But we've actually given advice to a business owner to go ahead and sell your property for $7 million, pay off your $1 million or $2 million bank note, go rent somewhere, walk away, put $4 to $5 million in your property. Did we get a loan out of it? No, but it was the right thing to do.
Yeah,
You short up the balance sheet effectively as well without debt.
Yeah, and I mean that's what a true partner, is supposed to do. It's not someone that's just has their own interests in mind. So I think that's huge, and it does go a long way with your clients and your relationships. That's a huge focal point of the business and what helps drive that growth. What are kind of shifting gears a little bit back to, trends and what we're seeing. Are there any property types that are faring better than others? Is there any differential there?
So we really focus on manufacturing and distribution. Although we have done other property types. So we've done Montessori schools, daycares.
Okay.
We've got some retail strip centers, still owner occupied. So
Right.
there's a tenant that's in there. But I would say we also do raw land. So there's land is kind of sometimes a dirty word in the lending sphere, but we're completely fine with it so long as it's a reasonable LTV and it's in a good location. It's not too rural or tertiary.
Right.
So we'll do land deals. There's always going to be an operating company that guarantees that. So those are the main property types.
Okay. And out of those main property types, is there a specific one where you're seeing, the most action or the most deal flow?
We're sitting in an office building right now. And it's a beautiful space. It's absolutely beautiful, but we probably would not finance it.
Yeah, I can't help but notice that as we walk through this building. And the issue is, that as we walk through this building, there's a lot of empty space.
A lot of empty space.
So this is a beautiful studio, but a lot of the other spaces are vacant, right? So we've basically pencils down on anything that smells like office, unless it's a very small owner occupied office that we could really get comfortable with the operating company and the loan to value.
Would you say that's a function of coming out of the pandemic and people reluctant to go back and commute?
Yeah, definitely. I mean, but it's also market driven. So, you have a place like Houston that was already overbuilt prior to COVID. So you've got, the office was bad in Houston before COVID. Now it's just worse.
Right.
And so those buildings are trading at 15, 20 cents on the dollar now over from 3 years ago. I mean, there was a building that was valued at $180 million in 2022 that just sold for 20. And the bank took $100 million loss on the note.
Think about Greenway Plaza in Houston, right? Greenway Plaza is 2.5 million square feet or something like that. The owner of the property got an offer right before COVID for $350 a square foot. They spend more money on security and utilities on vacant space than they actually make money in rents.
Wow.
That property is, and it's
tough.
public, there's public filings on it. It is under receivership. They filed bankruptcy, and the market value now is probably close to $50 a square foot for a Class A trophy, beautiful glass, 40-story tower complex. I mean, beautiful property. But it's who's gonna occupy? They need 1 million square feet tenant.
What do you think's driving like the increase in vacancy?
I would say work from home is a big part of it. Flexible, hybrid type of work structures, and businesses are just realizing they didn't need all that space.
Right.
And so there's not only attrition, but there's downsizing. So they may have had a whole floor. Now they're saying, well, we can go down to a quarter of that space.
Right.
And so it's kind of both kind of sides of it.
And my question relates to the rising interest rates. We talked a little bit about single to double digit interest rates and the ability to sell that to a prospect and perhaps going into maybe an interest only product. But do you see a correlation with going to a solid double digit interest rates with some reluctance in buyers even having a conversation, even though you might offer a product that could effectively be a lower cost per month with interest only in a balloon, let's say, to it's almost a non-starter because they can't absorb 12, 13, 14%. Or at least they think they can.
Yeah. So interest rates, 100% correlation with property values, negative correlation. Commercial real estate property values across the country, and this is Federal Reserve data, are down 15 to 25%, depending on the market and depending on the top property type, right? Of course, obviously, office has gotten crushed the most, so there's that impact to it. The other impact that interest rates have had, and it's deliberate, the Federal Reserve has tried to squash, really cool off inflation. And so by raising interest rates, it compresses or depresses or slows down. It's intended to slow down the stock market, even though we're at an all-time high. It's intended to slow down the housing market, even though there's a shortage of housing right now, and so buyers are still buying, even if mortgage rates are 7 or 8%. So they're intending to slow things down. It has slowed down commercial real estate transactions dramatically. In fact, in many cases, commercial real estate transactions are down 50% year over year. Just the number of transactions. Now that doesn't mean, just to be clear, that doesn't mean that prices are down 50%. It just means the velocity, the liquidity in the market has really shrunk. And so business owners that are buying a property right now really need it, because like their business is probably doing well and they need the space. If not, they're going to stay where they're at. And if they're leasing, they're going to try to write it out and, wait till interest rates come down a little bit. And if they're selling, why would you sell, at a time when prices are down 15 to 25%? So the sellers that we're seeing or either have a Class A trophy property in a superb location where prices are maybe down 5% or flat. But in many cases, we are seeing sellers. In fact, we've seen sellers ourselves that have to sell the property, and they're going to take a seven-figure, on a $5 to $7 million property. They're going to take $1 million haircut versus where they could have sold it a year and a half to 2 years ago. So, I mean, interest rates for sure.
Just to get out of the debt load?
Just to get out of the debt load, and just to, we've seen people who have a business where they're making $1 million in gross profit, and then they're spending all of it just to carry their property. So they're doing the math, and they're saying, you know what, I'd better just hit the cash register button, sell the property, and walk away with my equity. Problem is, buyers and sellers, there has to be a buyer who's willing to buy that property as well, right? So if a buyer goes to a bank, they're going to get a 7.5 to 8.5 to 9% interest rate from a bank. They can come to Flatbay Capital and they'll get a lower, maybe a 12% interest rate or something like that. It'll be interest only, so it will help them get into the property, but it has to pencil, right? That buyer has to say, gosh, I'm going to be paying $50,000, $60,000 a month, including property taxes, including insurance. Do I really need 80,000 square feet, or can I deal with 40,000 or 50,000 square feet? And it goes back to the technology that Elliot was talking about. We've actually seen people with smaller footprints doing more business because they're drop shipping, or they're figuring out different ways to adjust and do business.
Right. With that adjustment, have you guys seen any new products or strategies over the past year or so, with all the changes?
It's a new old product in private credit. 2 years ago, 3 years ago, nobody talked about private credit on Bloomberg or on CNBC, but now you can't. It's a hot topic. Every other interview is a Blue Owl or Ares Capital or Apollo Capital. We do the same thing that they do. We're serving that non-bank private credit market, but they're doing it at $20 to $50 to $100 million in transactions. Yeah. That's where we are sort of below the radar. One of the best kept secrets that at a $1 to $5 to $7 million loan amount, Apollo's not going to touch a $2 or $3 million loan amount. And so that's where I think we've seen the evolution of the private credit market start to get into the lower middle market space. Even a KKR and Goldman Sachs have started private credit funds to target the lower middle market space. Now, to them, lower middle market means like 10 or 15 starting. Right, yeah. They're not going to do, Goldman and KKR aren't going to do $1 million loan. We are. But that's evolution of the market, I would say.
So what are some of the key lessons Flatbay Capital has learned navigating all the ups and the downs and the changes?
The one that comes to mind to me as a credit risk person is an appraisal is only worth the paper it's printed on if it has real-time, accurate, up-to-date information. And so appraisers, per FIRREA guidelines, they are allowed to use trailing 12. In some cases, we're seeing sales comps from 2020, 2021, and 2024.
Yeah,
2024 appraisal with a 2021 sales comp. What happened in 2021? We're recovering from the pandemic, and as Elliot mentioned, there were trillions of dollars of influx of government stimulus. So what happened to commercial real estate prices? They were up 25%. So it's really the top end of the market. 2021, 2022, when interest rates were really, really low, so much stimulus in there, companies were flush with PPP money, so property values were really high. If you carry those forward to now, rates are higher, a lot of that liquidity has exited the market, but we're still saying that this property is worth what it was in 2022. So that's a lesson learned for us, is that we don't just trust the piece of paper just because there's a stamp. I was going to slam my hand on the table and said not to do that. So, but that's I think one obvious one.
But we've integrated. Yes. So to go to a question you had before, speaking exactly to George's point, is we've integrated a third-party technology now where we are also pulling our own comps. So we have a system now where we go and we pull our own comps, and this is at the pre-screen level, just to set expectations on valuation, because the borrowers always come in saying, I think my property is worth X, and all they're doing is taking the last appraisal they had and increasing it by 5 or 10%.
Exactly.
There's no justification for it, right? So we'll go in, we'll actually look at the data and say, well, here's actually what the market says.
And the comps you grab are current.
Oh, they're as current as they're current to the day.
That's good.
Yeah, that was
front end.
Something I was going to ask about is how the technology is adapted as well, and what part that plays, because what we're seeing so many new products enter the space with so many new lenders offering new products as well, and AI being the hot topic, the big thing. We're seeing people build programs based off of AI where it's learning your previous deals or specific things. It's kind of recognizing that. So when you're bringing in a new deal, it can flag sort of the threshold that you want it to flag as far as, from a risk perspective. It can flag just based off of your current portfolio and what it looks like. So I think that's so interesting how that's changing and adapting, and how people are implementing it into what they're doing day to day outside of that third party product that you had just mentioned. Is there any other, ways that you are utilizing technology that you weren't maybe 3-4 years ago?
I'd say we're definitely working smarter than we were 3 or 4 years ago, and we there's the evolution to the cloud that has been we have representatives from Dallas, Fort Worth, and representatives from Austin and San Antonio and Houston that can all talk, and that can be working real time in the same document. So we love technology, we leverage it, but the reality is that artificial intelligence. Sometimes I think I have AI. I don't know if it's real or not.
Old intelligence.
Old intelligence. Yeah, yeah, that's right. But their AI is going to help the industry from an investor standpoint, be able to look at all the market data and say, okay, I want to buy these 2 or 3 or 4 properties, and this is a good opportunity right now. From a lender standpoint, really we're going to default to OGI, which is going to be just sticky notes and yellow sheets of paper where we crunch the numbers, and we have to do. If we had a portfolio of thousands of loans, absolutely we'd have all that data aggregating, and but the reality is we're a smallish company relative to KKR and Apollo and Ares, and so we know every single one of our clients, and really there is no substitute to us going in person, shaking somebody's hand, reviewing the property, assessing the property, where's the ingress, egress, what's all around it. So there is no substitute, and I don't envision us in particular utilizing AI to really make a business decision right now. Elliot and I both have to give 2 thumbs up, and if one of us doesn't like the property's location or the management team, then we're just not going to do the deal.
Right.
And so that
Can't
AI
substitute
will
that.
enhance it, but it will not necessarily replace it.
Yeah, AI can't determine character,
Right.
And so they can't determine make sense of a story. And we do storied credits, right? So everything we do, something's happened, something wrong has occurred in the company. And
that holds true in a lot of your referral sources, ABL and factoring. They try very hard to adopt technology to eliminate some of their need to touch and feel, but collateral driven, you got to touch and feel it.
Yeah.
If you had your crystal ball looking out the next 2 years through a possible administrative change and that sort of thing, what are some catalysts to growth you might see, or what are the opportunities lie for you guys?
I'll answer first. I'll say that there is $1 trillion in just commercial real estate debt that is maturing, that had vintages from, let's say, 2017. It's not all 2020, 2021. So there's some vintages, 2017, 2018, 2019 vintages that had some really good interest rates. And the low point from an interest rate standpoint was when the Fed went to zero to stimulate the economy. And so there are some mortgages out there, commercial mortgages that have twos in front of them, right? A 2.75, maybe they're 10-year, 7 10s. That's what banks typically do in life cos. So there are going to be maturing loans. Think about it from a borrower standpoint. There's going to be maturing loans where they're paying 3% relative to the loan balance, and now, if the deal doesn't pencil and if they don't qualify for a bank extension or renewal, then they have to come to an alternative lender and pay 10 to 12%. So then now that's a 3 to 350% increase to their interest expense. So nobody steps into that situation voluntarily wanting to do it. But the reality is, out of $1 trillion that's maturing, there's a really, really, really high percentage that aren't going to pencil, that aren't going to qualify for bank refis and life co refis. And so I think we're going to be as busy as we are for a while.
Yeah, I think the trends continue from a deal volume standpoint. So we'll continue, I think, to see for at least the next several years a large wave of deals. And for us, it's going to be trying to pick the winners using a combination of mostly OI or OGI, whatever you want to call it, and some implementation of technology for an efficiency standpoint to find the right clients. So from us, from a growth standpoint, we've been very regional, and so there's markets that we have not been in yet. So we'll make some growth strides in some areas where we see stable and growing populations. We'll stay away from the places that are people are leaving, if you want to make it simple. And so that's our growth strategy. But there's no major, we don't have any major new product or something, that some brainchild we're going to come up with. It's continue to do what we do every day, and just book the right clients.
Yeah, makes sense. Yeah, that does. To kind of wrap us up here, what advice would you guys give to lenders or borrowers looking to navigate the commercial real estate landscape?
I'll take the lender's side of it. So from a lender standpoint, there's a couple different ways to answer it. So there's lenders that are good partners with us. So from a lender standpoint, think of the partners you can bring in to help affect a transaction. So always be thinking of partnerships to help reduce your risk and increase a viable outcome for your borrower. And for banks, we want banks to be proactive, and it's really typically in the borrower's best interest for a bank to be proactive too when it comes to when they're looking at downgrading a credit. The sooner they can have a conversation with us, the better. And so what we really look for is communication. So communication from our lenders, partners, communication from the banks that are exiting deals to pick up the phone, call your local Flatbay business development officer, and let's have a conversation and see if we can provide a solution.
All right.
I'll take the borrower part. So from a borrower standpoint, again, rates are high, and we get this all the time. A borrower will look at one of our term sheets and say, "Well, gosh, that's a little high. I was hoping for like an 8% rate," and I was like, "Wow, I'd like an 8% rate too from a bank." But that's bank and life co. Those are companies that when they borrow $5 million. They're probably making $5 million, and there's a 1-to-1 or 2-to-1 ratio, and sometimes banks will stretch to 3 times. But it's really about being realistic, and so yes, it stinks. We're on the borrower side. Like it is, I can't wait until rates come down. The Federal Reserve drops rates another 100, 150, 200 basis points. But the thing is, we're not going to see 2020 rates probably ever in my lifetime. We're not going to see a 2.5% residential home mortgage, probably not for a very, very long time. So we're going to get a reversion of the mean from a rate standpoint, but we're probably going to go from a federal funds rate of 5.5% to 3.5% to 4%, and it will normalize there because that's kind of historically where they've been. We're not going to get a 500 basis point drop unless there's a really significant recession plus / light depression type of economic tsunami that's unforeseen. Right now, the banking system is very resilient, very strong. Don't foresee that happening. The real estate market is strong, even though you've got pockets of weakness here and there. So I'd say from a borrower standpoint, be realistic. Rates are higher, insurance rates are higher, property tax rates are higher. But of those three, the interest rate is the one that has the potential to come down. Right. Your insurance is never going to drop, and your property taxes are probably not going to drop. Your interest rate may drop, and so you rent the loan, you buy the property.
I like that.
Yeah, great point.
Yeah. Well, Elliot, Jorge, it was, such a pleasure having you guys join us on this episode, dropping all your insights, trends, and, strategy, key points and takeaways. So we really enjoyed speaking with you guys and having you on. Vince, my co-host for today's episode, thank you for being my wingman today, joining us. Anytime. Yeah, absolutely. And to all of our viewers and listeners, thank you for this journey, that you've joined us on. Remember to stay informed, stay inspired, and stay on course to growing your financial platform. Until next time.